Hi, it's Brad from Ocean Consulting Services. In today's video, we'll be talking about reasonable collection potential, so-called RCP, getting into the detailed rules. Just a quick overview and some highlights. As you may know, reasonable collection potential is a key metric in all collection cases. It's a concept that needs to be mastered in order to deal with any collection activity. The RCP is an approximation of what the IRS could expect to collect if they enforce collection. In other words, they use liens and levies in order to force collection. In this video, we'll get into some details regarding the actual computation. Let's start off with assets. The IRS will want an accounting of all of your assets. That could be home, car, recreational vehicle, money in your bank account, retirement accounts, etc. Generally, except for cash, they'll take a discount of 20%. They call it a quick sale discount. This will be applied to the fair market value of your assets to approximate what the IRS would receive if they were to seize the asset and do a quick sale of the assets. Let's talk about debts. Debts relating to assets are allowed to be considered. The typical being mortgage debt or an auto loan. Basically, the IRS does not jump ahead of existing lenders. With respect to your assets and related debt, the concept is referred to as step into the shoes. The IRS steps into your shoes and gets whatever rights you have to those assets. For example, you buy a house and you purchase that with debt from a bank along with a down payment. If the IRS were to foreclose on the house, they wouldn't be entitled to the entire proceeds. They would only be entitled to the net proceeds after the first lender was paid off. If there are secured debts, typically the IRS will be behind the first lender and only be entitled to the net equity after payment of the debt. Let's talk about the next component of RCP, and that's future income. This is your monthly income. It's your cash income less cash expenditures. The current earnings are typically based on your current earnings, whether they're wages or income from self-employment, but that's not always the case. Say you're self-employed, having a down year, the IRS will not necessarily use that as an indication of future income. They may go back 3 years and average your earnings to get a more normalized view into your income. If you're an employee, they typically will use your current wages. However, if there are extenuating circumstances, if you're taking a new job and your wages are anticipated to increase, the IRS may use those anticipated wages. If you're currently unemployed, but the IRS expects you to become employed, they'll adjust your income accordingly. Of course, that income now needs to be offset against future expenses. And again, important to remember that this is cash flow expenses. These aren't expenses relating to determining your taxable income. So, starting point always is beginning with a list of all your actual expenses. Now, the IRS has many standards that they may apply to limit those expenses, but again, importantly, realizing that the starting point for any debt collection situation is to quantify your actual expenses. Now, the standards that they apply are typically based on government data. For example, the Bureau of Labor Statistics survey may be used to provide certain data relating to expenses. And the goal of this is to provide some sort of standardization and equity among taxpayers. The IRS wants to avoid questioning each and every expense of each taxpayer. They want to come up with some standards to apply to make the process more efficient and more equitable. In many situations, the allowed amount by the IRS is less than actual, and this typically comes up in the situation of housing, where the IRS will look at their standard amounts for housing and they'll look at what you pay and they'll allow the lower of the two. So you may be limited in the deduction for your housing expenses. I'll frequently have taxpayers ask me, well, does that mean the IRS expects me to sell my house and to move to something less expensive? And the short answer is no. The standards in this computation is merely a mechanism to arrive at an amount that you'll either pay monthly or an amount that you'll settle your tax debt for. It's not intended to actually control how you will earn money and spend it in the future. Once an amount has been determined, the taxpayer is free to determine how to actually make those payments. Now let's get into a discussion regarding detail of expense types. Two broad categories, necessary and conditional. Necessary expenses can generally be used with any collection alternative. In other words, installment agreement or offers in compromise. Conditional expenses are those expenses that usually are only allowed in situations where you will full pay your debt. In other words, a full pay installment agreement. They typically are not allowed in a debt compromise situation, such as an offer in compromise. Necessary, according to the IRS, is for the production of income or for the health and welfare of the taxpayer's family. So these are sort of basic living expenses. How much do you need for food, shelter, clothing, and to maintain your job? Conditional is a term that applies to any other expense. So what are necessary expenses? The IRS puts these into broad buckets, the first of which is called food, clothing, and miscellaneous. And as the name implies, this covers clothing, food, personal care, miscellaneous expenses. There's a standard amount provided to each taxpayer for use in the computation. Out-of-pocket health care is another item, and this is for medical services, doctors, etc., and other healthcare expenses. There's a standard amount provided. However, if a taxpayer incurs more expenses, they are allowed the increased deduction provided there's substantiation of the expenses. Housing and utilities. This includes either mortgage or rent, includes insurance, repairs, etc. There is a standard provided, and the allowed amount is the lesser of the actual that you're paying or the standard amount. For transportation costs, there are automobile costs and also public transportation. With respect to automobile, there are two categories. One is ownership and the other is operating. Ownership costs are lease or loan payments. Operating costs are the other expenses, your fuel, insurance, repairs, etc. For public transportation, if there is no car available, there's a standard amount that can be claimed by each household. If public transportation is being incurred in addition to auto expenses, then the amount allowed is the lower of the actual expenditures or the standard amount. There's also a category of other necessary costs. These could be accounting and legal costs, child care, assuming the child care is incurred so that the taxpayer can work, court-ordered payments. So, for example, child support and alimony are allowed as other necessary expenses. Mandatory wage deduction. So if you have union dues or a deduction from your pay for uniforms, that would be allowed as well. Life insurance, but only for term life insurance policies. Secured debt, so that'd be items such as your home equity line of credit. Any current taxes, so all wage withholding or estimated taxes being paid. Delinquent taxes are also allowed with certain limitations. Also student loan payments. So a number of these expenses are allowed. They're just in the bucket of other expenses. Now let's talk about conditional expenses. These are expenses that are not required to maintain, the basic living standards. They're usually allowed with installment agreements that either use what I'll call the 6-year rule or the 1-year rule. In the 6-year rule, you're expected to be able to full pay your tax obligation within 6 years using your actual expenses, including these conditional expenses. Typically, the IRS will allow those expenses to be considered in the installment agreement. Under the 1-year rule, you're not expected to fully pay the debt within 6 years. However, the IRS will allow you in the first year to use your actual expenses before they will then impose their standard on your expenses, and the payment will increase after year 1. Examples of these expenses are minimum credit card payments, voluntary retirement plan contributions, payments towards unsecured debt, court-ordered payments for things such as child education, etc. These amounts, again, are considered conditional. They would be allowed if the IRS is proposed to be full paid for their liability. They're typically not items allowed if you're asking the IRS to compromise your debt. In other words, an offer in compromise. In conclusion, the RCP determination, it's critical to all collection situations, regardless of you're looking for the IRS not to pursue collection. You want to be currently not collectible. You want to enter into an installment agreement. You want to pay your debt over time. You want the IRS to actually settle your debt for something less than you owe, so an offer in compromise. You believe you're entitled to relief under the innocent spouse provisions. All of these types of programs start with the concept of RCP. And unlike taxable income, RCP is based on IRS rules that take into account equity and fairness. They're less well-defined rules, they're more open to interpretation, and my advice is to consider this when hiring a service provider to deal with your tax debt. You'll want someone who's familiar with the IRS laws and regulations, but also with this particular area, the collection area. They have knowledge of the Internal Revenue Manual, they have knowledge of how the IRS deals with these situations. Well, that's it for today. Thanks for listening, and stay tuned for additional videos. Thanks. Bye.